What's going on, money lovers? Welcome back. It's been an amazing week so far. We are rapidly approaching 100 subscribers, which I'm very excited about. Couple that with Tesla's blowout earnings yesterday, and I can definitely quote Drake and say, life is amazing. It is what it should be. If you've enjoyed the videos so far, don't forget to show your friends and family too, and let's keep the channel growing. Also, let me know in the comments below what you want to see more of in the future. I read all the comments, and a lot of my videos are based on people's requests. Some people make memes, I'm just trying to make you millions. So without further ado, let's jump right into AT&T. So AT&T has been trying to sell off its DirecTV division, which has been bleeding subscribers, and it's just not part of its core business outlook for the future. However, they're getting offers in the $15 billion range when AT&T paid $49 billion for DirecTV just 5 years ago. So they're going to get less than a third of what they paid for it. This deal also is partially responsible for their big debt burden, as they took on $18 billion in debt to acquire it. So there's two ways you can look at this. One, they realized it was a mistake and they're finally getting rid of it before it's worth even less. But at the same time, this is not that long ago. I mean, do you want to invest in a company that is making short-sighted decisions without thinking long-term? What's stopping them from overpaying for the next service that's not going to pan out the way that they had hoped, and then they're going to have to sell it at a loss again? You don't want to see a company having a fire sale for its assets. This is definitely a red flag because it shows me the company lacks foresight. So hopefully they can turn this around. And I still haven't seen what's stopping them from making the same mistakes in the future. I mean, you could argue that they overpaid for Warner Media as well, but we're not going to know how that plays out for a few more years. Their new streaming service, HBO Max, will be a big part of their focus moving forward, but they now enter the streaming wars. Meanwhile, they've entered into a very crowded playing field with some tough competition, and while I think HBO Max does have a lot of great content, they're going to have to keep dumping a ton of money to stay relevant and keep up with their competitors. I mean, Netflix spent $16 billion on new content in 2020. Amazon plans to spend $7 billion. Apple TV Plus, $6 billion. Disney Plus, a budget between $1.5 and $1.75 billion for 2020. And HBO Max, they're going to spend between $1.2 and $1.5 billion this year. NBC Universal launched Peacock. They're planning to spend $1 billion. So I can't rule out, what if with HBO Max it doesn't go as planned and it's a flop? I mean, they are pretty late to the party here. As we see, there's tough competition. This is an industry that requires a lot of capital, and as we see, AT&T still has net debt of $149 billion. Yeah, they paid down a little bit from the high of $180 billion, but that's still a ton of debt. They need to execute perfectly or they're going to run into a lot of issues. We take a quick look at their Q3 earnings report. Some areas of strength. They are a leader in 5G. They're committed to supporting the dividend. They have got a 36-year record of upholding it. They're reducing debt, and they are monetizing non-core assets of their portfolio. So that's something that the sale of DirecTV would fall under. So they did have some strong subscriber growth. They added a lot of new paid subscriptions, and HBO Max is growing. So AT&T expects $26 billion in free cash flow in 2020, and they expect to pay the dividends out of that free cash flow in the high 50% range. So figure once they pay out the dividend, they're left with, let's say, $10 to $12 billion in cash. They can use some of that to pay down the debt. And let's say that they do sell DirecTV, and I'll give them the benefit of the doubt. Let's say they get $20 billion. So that's $30 billion in cash. Between free cash flow and the money from a possible DirecTV sale, we're talking about $30 billion. So subtract that from the $149 billion that they currently have. That still leaves them with $120 billion in debt. Now, they were able to lock in a lot of this debt at low interest rates, and their debt load for the next 5 years is definitely manageable while maintaining the dividend. Nonetheless, this is still a ton of debt, and they're going to have to execute perfectly, or else they're going to run into problems with this long-term debt later on. Quick recap before I get to the last couple things that are very important. So they have HBO Max, definitely has a lot of potential. They've got a high dividend yield. It's over $2 a share, and it's close to 8%. With the potential sale of DirecTV, this could free up some more cash and take a big burden off their shoulders and let them put more focus into streaming. And some major cons: they have a staggering amount of debt, $149 billion. We're in the midst of a tough transition right now, and it's definitely stressed further by all this debt. This is a company that's historically been a telecom company, and now they're trying to become more of a media company. With that comes all of its own challenges, and it's definitely going to be tough to compete with the likes of Amazon and Disney Plus and Apple TV Plus and all the other competitors who are years ahead and may not have to deal with as many liabilities where AT&T does with They're losing customers. They have business models like with DirecTV that are going out of favor. So since AT&T is not a huge growth story, the only reason it would be worthwhile for me to own, since I'm young, everyone's situation is different. If you're relying on it just for the dividends, your approach may be different. But for me personally, if I'm in it for the dividends, I want it to be a company that I know I can own forever and continue to collect the dividends. So enter the dark horse, Starlink. If you don't already know, Starlink is a segment of SpaceX, another one of Elon Musk's companies. SpaceX created its Starlink mega constellation with one goal in mind: to provide more affordable, high-speed internet access around the globe, especially for those in rural and remote areas. Starlink has the potential to start disrupting AT&T and the telecom industry as a whole within the next 5 to 10 years. So why would I want to own AT&T when there's so much uncertainty in its near future, and I don't see a whole lot of upside? Furthermore, AT&T has stayed stagnant and underperformed the broad market in the last 5 years, which have been arguably some of the best years in the stock market's history. So for the reasons I've outlined, I have decided to sell my shares of AT&T. Now, I've been considering this for a while, as I just don't think it's the best deployment of my capital. As a 24-year-old, I have a lot of time and can get better returns elsewhere with my money. I'm also using the proceeds from my sale of AT&T to build up my cash reserve. We are heading into the winter of uncertainty. With the election coming up and the pandemic numbers starting to rise again, I think we are in for a bumpy ride and would like to have some cash on the side in case an opportunity arises. Now, everyone's circumstances are different. Just because AT&T doesn't fit my investment thesis does not mean it should not belong in your portfolio. Everyone's circumstances are different, and if you want steady cash flow and are not as interested in growth, then it may be worth holding. You could also make the argument it's at a good buying point right now, as it's pretty much at a 5-year low. Let me know what your thoughts are in the comments below. Are you buying AT&T? If you enjoyed the video today, don't forget to like and subscribe. And remember, as always, this is not investment advice. I'm only sharing my personal journey and my opinions. You should always consult with a financial advisor and accountant before making any investment decisions, and do your own research. This is Vinny from the Investment Club, and I'll see you next time.